Bonjour tout le monde. Good morning, everyone. My name is Hélène Nadeau, and I'm the Vice President of the National Association of Federal Retirees. Thank you for joining today's seminar. Your response to this event has been tremendous, and this is one of the largest Zoom events we ever have done. So we ask for your patience if we run into any technical difficulties. We will do our best to fix them promptly. I also want to explain how you can access the simultaneous interpretation service and the French side. I will give those instructions in both French and English. Alors, pour faire passer le canal audio de l'anglais au français et inversement, amenez votre curseur de souris n'importe où sur la fenêtre de Zoom et une barre d'outils apparaîtra au bas de l'écran. L'un de ces outils ressemble à un globe terrestre et s'intitule Interprétation. En cliquant sur cette icône, vous pourrez passer d'une langue à l'autre grâce à l'interprète qui travaille en coulisses. To switch your audio sound between English and French, move your mouse anywhere on the Zoom screen and a toolbar will appear at the bottom. Click on the icon that looks like a globe and is labeled Interpretation, and you will be able to switch between English and French. We thank Pauline Dion-Rolat, our interpreter, whom we know will be providing an excellent service. Merci d'avance, Pauline. Pour la présentation des diapositives, vous verrez des diapositives en anglais sur votre écran Zoom, mais vous pouvez afficher les diapositives en français en déplaçant votre souris n'importe où sur votre écran pour faire apparaître la barre d'outils de Zoom. Cliquez sur le bouton de discussion et cela ouvrira la fenêtre de discussion et vous trouverez le lien vers les diapositives en français. Cliquez simplement sur le lien pour parcourir les diapositives françaises séparément. For the slide presentation, you will see English slide on your Zoom screen, but you can switch and view the French slide by moving your mouse anywhere on your screen to make the Zoom toolbar appear. Click on the chat button, and this will open the chat window where you will find the link to the French slides. Just click on this link to go through the French slides separately. Now, let me introduce you to our National Association President, Roy Goodall.
Merci bien, Hélène. Bonjour tout le monde. Good morning, everyone. I'm delighted to welcome you to our webinar today with Rob Carrick, who will talk about weathering stock market volatility and other financial challenges ahead. First, I would like to begin by recognizing the First Nations on whose traditional lands our association office is located. This is unceded traditional territory of the Algonquin Nation and holds great historic, social, and spiritual significance for the Anishinaabe Algonquin people, and whose presence here reaches back to time immemorial. Rob Carrick, our speaker, is a nationally known author and personal financial columnist who has been with the Globe and Mail for over 26 years. Rob sees his column as one regular guy's attempt to make sense of the world of money. His personal goal, and this goes for his financial writing and today's seminar, is to have you leave this event saying, "Now I understand." That is our goal too. The National Office of the Association and the Ottawa branch are proud to be collaborating on this webinar. We believe that we timed it well because November is National Financial Literacy Month, but mostly we know how important it is for you to build and expand your financial knowledge so that you can manage your money well and enjoy a financial environment. And you proved this by signing up for today's webinar. In fact, we have almost 1,400 of you registered to attend. However, I must remind you that this webinar will not provide investment advice regarding specific investments. The association takes no responsibility for any investment decisions that you may make, and we are not recommending any specific investment products or companies. Now I want to give a special welcome to anybody here who is not yet a member of the association. We hope this webinar will inspire you to join us. I also want to remind our members in the audience about the annual mega recruitment drive. From now until December 31st, every time you successfully recruit a new member, you will receive a ballot to win one of 14 great prizes, including the $10,000 cash grand prize, courtesy of Johnson Insurance. You will also receive a $5 Tim Hortons gift card for every new member you successfully recruit. There are no limits to the number of times you can be entered into the grand prize draw, so the more new members you recruit, the more chances you'll have to win. Now, Helene Nadeau, our Association Vice President, will explain how we will handle questions and answers today and our follow-up procedures after the webinar. Thank you. Helene?
Merci, Roy. I am also an Ottawa branch member, and I'm very proud to be part of this groundbreaking initiative to expand our local financial literacy efforts to the national level. So we are recording today's seminar, and within the next few days, we will send you an email with instruction on how to access the recording and the slides, and also more information on the Mega Recruitment Drive. There will be a question and answer session with Rob after he finishes his presentation. So to ask a question, click the Q&A button at the bottom of your screen to open the Q&A window. Type your question into the Q&A window and then click on Send to submit your question. You can do this at any point in the webinar. Please note that the chat function will not accept questions, so use the Q&A window to submit questions. We'll try our best to answer as many questions as possible, but we know we won't be able to answer them all. However, you can help us by identifying which questions are more important. You will see the question others would like to ask in the question box on your screen. By clicking on the thumbs up icon, you can vote for the question most important to you. We will try to focus on the question with the most thumbs up. N'oubliez pas de déplacer votre souris pour faire apparaître la barre d'outils de Zoom sur votre écran et cliquez sur le bouton d'interprétation ou l'icône globe pour l'interprétation simultanée et cliquez sur le bouton de discussion pour les diapositives en français. Remember to move your mouse to make the Zoom toolbar appear on your screen, and click on the interpretation button or the globe icon for simultaneous interpretation, and click on the chat button for the French slides. Now, you have been very patient, and we don't want to take, we do not want you to wait any longer. So we are going to turn la parole over to our special guest speaker, Rob Carrick.
Thanks for joining us, everyone. I sat down to work on this presentation a little while ago, and I thought, wow, do we ever have a lot to talk about today? There is so much going on in the financial world. I've been writing about personal finance and investing for about 30 years, and this may be the wildest time that I have ever seen, the most volatile, the most surprising. I'm going to talk for about 40 odd minutes and then throw it open to questions. I could talk for 400 minutes and show you 400 slides, and I still don't think we'd cover every nuance of what's happening in the financial world. Now, let me get my slides up. There we go. I call this talk the 2022-23 Retirement Handbook. I hope you'll come out of this feeling a little bit more informed about what's going on and what your options are and how things may play out. If you've got follow-up questions in the weeks and days and months ahead, you can always email me, rcarrick@globeandmail.com, and I'm happy to answer any follow-up questions you have, especially if you're a reader of my newspaper, the Globe and Mail. 5 storylines I want to focus on today. Number one, and I'm sure I don't have to tell you this because you know it already if you've checked your investing statements. Stocks and bonds are both getting hammered this year. We've almost never seen anything like this before. In fact, bonds are down more than stocks. Bonds are the safe thing you hold in your portfolio to cushion against the stock market decline. We've got a stock market decline, but what do we have? A worse decline in bonds. So diversification isn't really working very well this year, and that is a key issue for retirees who are managing their investments and trying to minimize volatility, trying to maintain their capital, grow it a little bit without taking on undue risk. The biggest challenge facing the economy and individual households and people in business is inflation. You're retired, so you've probably have some recollection of the inflation of the 1980s and the early 1990s. I know what we're seeing today isn't quite up to those standards, but if you're in the Gen Z, Millennial, or Gen X generations, or you're a younger boomer, you've never really, as an adult, had to cope with these inflation levels. They're exceptional. The Bank of Canada is extremely alarmed about inflation. That is why interest rates are rising. That is what's playing havoc in financial markets, these interest rate increases. And we are waiting for inflation to buckle. It's shown signs of doing that, but we are not there yet. And until we get there, we're going to be living in a very abnormal world. Those interest rate increases I just mentioned, that is going to most likely bring on a recession. I'm not predicting a recession, but I will note that Royal Bank of Canada, the country's largest bank, issued an economic forecast a week or two ago, in which they said we will have a modest recession. We will have one, not we may. So when an institution like that removes all hedging and says we will do something, I pay close attention. Another factor that is playing a large role in everybody's economic thinking is what's happening in housing. We had a tremendous rise in housing in late 2020 and 2021, all the way till February of this year. And then the Bank of Canada said, hey guys, we're serious about raising interest rates, and housing has been falling ever since. I could generalize using national numbers. We're down about 6% year over year, but some markets are falling more than others. It's a very local thing, but the trend in housing is lower. Equity that was built up in the rally of 2021 is starting to erode. We're still, if you're a longtime homeowner, you're still got a property that has accrued massive amounts of equity, but that amount of equity is declining and likely will continue to do so. All this feeds into what we still don't have a firm grip on in terms of what will the new post-pandemic normal look like. We're going to need to work through inflation. We're going to need to see interest rates normalize. We're going to see the world needs to calm down for a little while. And then we'll see what is life like. I don't know whether you remember much about the economy in 2019, but it was actually slowing down. We were in sort of a slow growth period, modest interest rates, which promoted borrowing and housing. And are we going back to that post-pandemic, or are we going to be in some sort of a new anomaly going to emerge that takes us in unexpected directions? Let's start our look at specific financial indicators with the stock market. So here I have given you a 5-year chart for the S&P TSX Composite Index. Of course, that is the benchmark for gauging what's happening in the Canadian stock market. It's about 300 stocks, all the big blue chips that are probably in your investments, plus some mid-size and some smaller stocks. And the chart shows you, look at 2020, that was the extent of the crash that happened back then. Isn't that an unbelievable drop in such a short period of time? But even more unbelievable is the rise after that. We got up to about 2,200 for the composite index. We're now down to the $18,000-$19,000 level. I showed you that to give you some perspective on the stock market decline last year. On my greatest hit parade of worst stock market declines, I don't think this is in the top 5. I feel like this is a fairly modest, orderly decline. I don't know whether you recall the 08-09 financial crisis. We were losing like 1-2% on the stock market per day. we were getting days where losses were in the many hundreds of points, thousands of points. Nothing like that here. I have not felt a sniff of panic. This is a perfectly normal decline after a year like we had in 2021. It's a perfectly normal year in terms of all the uncertainties we face. I've already had a few retirees email me and say, do you think the federal government is going to give us a break on our RIF withdrawals for the year because stocks have retreated and the value of our RIFs is declining? And the answer is no. This isn't nearly enough of a stock market decline to cause that to happen. We're going to need something much more. I'm not a stock market prognosticator, but I'm not entirely sure we're through the worst of this decline. But a lot of people are pointing out that the stock market isn't egregiously overvalued. It's not too bad where it is. We may see more downside, but I think things are fairly contained right now. And if interest rates were to come down a little bit, inflation were to be tamed, and we could work through whatever sort of economic slowdown ahead, I think stocks could find a base and move higher. Bottom line here is there's nothing to panic about in the stock market. I know that dividend stocks are a tremendous area of interest for Globe and Mail readers and for retirees in general. And so I included this chart here of it's the 6-month chart of the share price of Fortis Inc., which is a quality blue chip dividend growth stock. I use it as a good proxy for safe utility stocks that I know retirees own a lot of, and for good reason. They pay good dividends. They almost never cut their dividends, and many of them grow their dividends every year. And if you're looking for a hedge against inflation in your investment portfolio, you can hardly do better than dividend growth stocks, which have a history of increasing their dividends every year. There are many of them. Fortis is one that increased their dividends on an average annual basis that historically has been very close even to today's elevated inflation rate. And that is a great answer to inflation. Prices are going up 6%. My dividend stocks are raising their dividends 4, 5, 6, 7, 8% on average. I know people tend to think that dividend stocks are safe. Not really. They're not. They can go down. They are susceptible to market forces. So Fortis is an example of a utility stock, and stocks in that sector and in telecoms and other sort of safe sector are declining this year because the general stock market is declining, but also because they tend not to do well when interest rates are rising. If you own dividend stocks, you may find that they decline less than the market. If you own energy stocks and we have a pullback in energy prices, you'll find those decline more than the market. So be ready for a bumpy time with dividend stocks as much as your broader investments that hold all kinds of different stocks. The shocking news in investing is not the stock market. As I said, we've had a fairly normal, orderly decline there. What's happening in the bond market is, in my investing lifetime, unprecedented. It is a shocking rout in the bond market. I've got a chart here for you of the iShares Core Canadian Universe Bond ETF. It's an exchange-traded fund, and you could use it or ones like it to basically cover off the bond market in your portfolio. So if you said, I want 40% bonds, an ETF like this could be your 40% exposure in bonds. Year to date, this ETF is down about 15%, and that includes bond interest as well as changes in bond prices. So this ETF is a proxy for the bond market. The bond market is down about 15% this year. That's the safe portion of your portfolio. That's what investment strategists and advisors tell you to hold to cover you off in the bad times. So what is going on here? Bonds decline when interest rates rise. When interest rates decline, bonds increase in price. And that is the story of bonds over the past 30 years on an average annual basis. Central banks have been cutting rates, including the Bank of Canada, and that's been great for bonds. So we've seen we've seen like average annual returns from bonds and bond funds that are quite satisfactory. They've usually been not a dynamic part of our portfolios, but we can see why we hold them. The logic is there. We've had a sharp rise in interest rates this year, and so we've had a sharp decline in bond prices. And that includes the prices of individual bonds that you may own, the price of bond mutual funds you own, and the price of bond ETFs. This will continue as long as interest rates keep rising. Now, the Bank of Canada has said that the Bank of Canada governor said as recently as I believe yesterday to a Senate banking committee that inflation is still too high and that we will still see more interest rate increases. The Bank of Canada will set rates again in early December. I could see rates going up another half a percentage point. That's the Bank of Canada's overnight rate, and that will echo in the bond market. That says to the bond market, rates aren't coming down yet. And so we're not going to see any stabilization in bonds until that happens. Now, as bonds prices fall, yields rise. That's a little a strange quirk of the bond market. Falling prices mean rising yields. So my little chart here shows that the 5-year Canada bond, 5-year government of Canada bond, and I use that as sort of a reference. What's happening in the bond market? I look at the 5-year Canada bond. And one of the reasons is that 5-year mortgage rates are very much influenced by this rate. So that's why it's a particular interest to me. I caught a snapshot here at 3.742%. Bonds have since declined a little bit. So that's good news. The Bank of Canada, when it set rates last week, said everyone expected us to raise 0.75. We're raising 0.5. People took that to mean maybe the bank is sees good things happening in the fight against inflation. As I noted, I think rates still have a little more to go up, but I think we've seen the worst of it. So this chart of rising bond yields, I think we may be around the peak of that right now. So what do rising bond yields mean? It means that if you were to buy a bond today, you could get a much higher yield than you did 1 year ago. So prices of bonds are declining, and the way we can put that to use in our portfolios is to buy new bonds which have much higher yields, or we can buy guaranteed investment certificates. The outlook for cautious investing or saving through GICs is phenomenally good right now. I've been writing a lot about GICs cracking the 5% mark, and readers have been devouring this content. It's super interesting to me because GICs haven't really been a factor in investing for the masses in decades. No, there used to be a strong contingent of people who prefer to sit out the stock market, invest in safe GICs, collect their 5-6%, and that was perfectly fine for them. But interest rates in the past 30 years have mostly gone lower, and anyone who shops for GICs knows that 1% and 2% were pretty normal even 12, 15 months ago. Rising bond yields have sort of blazed this path for higher interest rates. And I took this little snapshot a little while ago, and you can see that Tangerine Bank, it's a name that we're all familiar with. It's an online bank. It's a subsidiary of Bank of Nova Scotia. A lot of people have for decades had savings accounts at Tangerine, and they're offering 5.2%. So you can deal with a name bank and get 5.2%. You can see that there's by my chart here, that there's a number of alternative banks. They operate online. They've all got deposit insurance schemes of one sort or another. They're either members of Canada Deposit Insurance Corporation or provincial credit union deposit insurance plans. They also offer 5% for 5 years. People in the investment industry are scoffing at these 5% rates for 5 years. They say you could do better than that in stocks. They say that inflation at 6.9% leaves you with a negative real rate of return and after inflation. What I reply to that is inflation is not going to be 6.9% through the whole 5-year term of your GIC. And I am very, very confident that inflation will be much lower than 5.2 for a goodly portion of the term that you hold this. So if your 5% for 5 years is a little bit negative on an after inflation basis now, in a year or two, you could see it be positive and then quite substantially positive. And then there's the fact that you can do better in stocks. Yeah, I think there's a very good chance that over the next 5 years, the stock market could average better than 5.2%. But remember, this is an after fee return. So maybe your 6% or your 7% return in the stock market is actually 6% after fees. And then there's the risk of big volatile moments, scary moments when you're tempted to sell. With the GIC, it is stress-free, it is drama-free. I'm a big fan of putting some money into these. I've done it myself. I mean, when you can get 5 years at 5%, I've seen that so rarely in the past 30 years that I think it's an opportunity to be considered. You can use GICs for savings. Let's say you have some money that you want to put away and you're comfortable locking it up for 5 years or 1 year, 2 years, 3 year, 4 years. You could use GICs for that. Another alternative is to use them as a substitute or a complement to the bonds in your portfolio. So if you held like a diversified bond fund, you could say that's going to be part of my fixed income or my bond holdings, because when interest rates decline, that's going to rise in value. And you could say, I'm going to use GICs for part of it as well, because I know that those won't decline in price. They'll give me the interest rate that's promised. They're safe because of deposit insurance. And that's a nice stable way to round out the safe portion of my portfolio. Notice a quirk of the chart here. Look at the 1 year rates, the best 1 year rates, and then look at the 5 year rates. They're pretty similar. That's really rare. When 1 year rates are pretty much the same as 5 year rates or even higher, that's a signal that's being sent by financial markets that they're concerned about inflation. And I mean, not concerned about inflation, concerned about a recession. And we pretty much know a recession is going to happen. And once there's more clarity for the economy, you'll start to see 1 year rates be far below the 5 year rates. But right now, you can use a strategy called GIC laddering. That's where you buy equal amounts of GICs with terms of 1 through 5 years. And every year when a GIC matures, you buy a new 5 year term. You can set up a ladder of GICs and get a blended average interest rate of very close to 5%, which is, historically speaking, very, very good. I think when we arrive at that new post-pandemic normal I was talking about earlier, I think you're going to see 5 year GICs as a fond memory and pretty much unobtainable. We're not going to go back to the interest rates of 2020 and 2021, but there's going to be a medium between where we are now and where we were then, and these GIC rates are going to be gonzo. I've talked about stocks and I've talked about bonds. Now let's talk about when you blend them together into a balanced portfolio. In investing land, 60-40 is what people mean when they toss off the term balanced portfolio. It doesn't have to be 60-40, but that's what most people mean. And it's considered a very safe, prudent default mix for your portfolio. It's quite suitable for today's retirees. You know, if 50 years ago, it might have been 40% stocks for retirees and 60% bonds, but retirees are living longer now. And I think you need to be growing your savings a little bit while also having a protective element in there in terms of the bonds. So 60-40, I think, works pretty well if you're retired recently and you have reason to believe through your current health that you're going to be you can expect more decades more of life. 60-40 is well worth thinking about. But what happened with 60-40 portfolios in the past 12 months? Here I've given you a 1 year chart, and it is for something called the Vanguard Balanced ETF portfolio. I'm going to talk about this a little bit more later on in the portfolio, but this is an asset allocation ETF. It's an exchange traded fund, trades like a stock, and basically gives you a balanced portfolio all in one package. So you buy this fund, instant diversified portfolio. It has got 60% in Canadian, US, and international stocks, and 40% in bonds, mainly Canadian bonds. This would be for someone who says, I want a balanced portfolio. I don't want to be thinking a lot about buying all the different parts. I want it all managed for me at a very reasonable fee. And 3 years ago, this would have been considered a somewhat conservative, prudent, low drama way to build a balanced portfolio. But what happened? You can see the sharp downturn. Portfolios like this are down around 12% this year. And that is worse than if you had just held stocks. So that's pretty shocking, because the idea is you balance the portfolio to avoid the worst of the stock market. This year, you've balanced portfolio and you've done worse than the stock market. So where does that leave investors? A lot of investing strategists have talked about maybe going to a 70-30 mix. That's where you would have 70% bonds, 70% stocks, 30% bonds. Another thing you can do is you can go very short term with the bonds. Stick to bonds that are maturing in 1 to 3 years. They've gone down less than the broader bond market. You could also use GICs in there to sort of cushion what's happening in the bond market. But I don't want people to go around thinking that balanced portfolios are dead and they're for suckers. They've had an exceptionally bad year this year, but I do not believe that the 60-40 balance is a defunct strategy. I think it has a future. In fact, I would argue today that there is a buying opportunity in balanced portfolios. Stocks are down, bonds are down. You get a chance to buy low in both categories. As soon as interest rates plateau and then start to head lower, the bond market is going to come back strong. And you would have that working for you in a balanced portfolio. Lower rates would also be good for stocks. And so at some point in time, you would see a rally back in stocks. You could have a double-barreled rally in your balanced portfolio. And that is something to consider. If you've seen stocks and bonds both down and you're thinking, what would I put my money into to take advantage of this buy low opportunity? I would say put it into both sides of your portfolio, the stock side and the bond side. There are buy low opportunities in both areas. The big issue in the economy today is inflation. You probably remember about 24 months ago, the governor of the Bank of Canada, as well as the head of the US Federal Reserve and other central bankers saying inflation is not a problem. We've pumped a lot of money into the economy to prop it up during the COVID lockdowns, but we feel fine with it. Well, what do you know? Inflation built up and it has, I don't want to use the word exploded, but you can see by this chart here how much the increase of the past year has looked compared to the inflation stability of 2018, 2019, and early 2020. You can see by this chart that inflation has come down slightly. Very good news. The question is it going to come down to the 2 to 3% range where the Bank of Canada wants it? We've got some work to do. That's why I say interest rates are going to keep rising. But inflation is the biggest problem for the central bank, which means it's the biggest problem for Canadians because they're raising interest rates. It's a particular problem for retirees. I mean, there's this old cliche of the retiree on the fixed income, and there's some truth to that. You know what? Your pension and your OAS and your CPP are your finite resources. Now, more and more retirees are building up their own investment portfolios. And in those portfolios, it is possible to build in some inflation protection. I've talked about how dividend growth stocks can provide that. But exposure to the stock market in general is a good inflation hedge. So I think we've seen the worst on inflation. I don't think we are going to come anywhere near the highs of the early 80s when bond yields and mortgage rates topped 20%. The Bank of Canada has been, although they misjudged things a little bit, They're on it now, and they are pushing hard with high interest rates to get inflation under control. It seems to be working. I think the central bank is going to want to see several more months of markedly declining inflation before it can relax its fight against higher living costs. So I think we're going to have to live through higher inflation for a little while yet. Food is a big problem, and it's related to sort of global market forces. Fuel is an issue in inflation, gasoline and home heating fuels. Another interesting quirk of inflation is that a lot of it is being caused by people buying things and paying the higher prices and giving retailers and service providers the confidence to raise prices and keep them higher. If you look at spending in restaurants and on travel and on certain other services, we are way ahead of pre-pandemic levels. I think eventually this spending spree, it's almost like a post-pandemic celebratory spending spree. It's going to die down a little bit, and that is going to help in our fight against inflation. We're not there yet, though. To me, this is a key topic for retirees and everybody else in the economy. House prices are declining. This chart shows you the red is the average house price in Canada. The blue is more of a notional benchmark created by the real estate sector to sort of smooth out anomalies, etc. So the average price is very much influenced by big markets like Toronto and Vancouver. So that tends to accentuate on the upside, and it tends to accentuate on the downside. Regardless of which of those lines you would prefer to look at, the trend is down. I know the latest tick on the red is up. We did see a little tick higher in prices in Toronto and Vancouver last month, but I wouldn't pin your hopes on anything permanent there. I think nationally, housing is under pressure from higher mortgage rates. You know, the huge rally of 2020-21 was fueled by low interest rates. I know a lot of people want to tell you it was high demand and low supply, and that if only we build more houses, this would instantly stop. And yes, I completely agree, we need more houses, but we had out of bounds demand for houses created by low interest rates. It made expensive houses totally affordable in a lot of cities. Parents were raiding their savings and giving money to their kids because they thought prices are going up. It's affordable to buy. We should get in and let our kids enjoy these price increases. But higher mortgage rates have made it more expensive to finance houses at the prices they hit in 2021 and early 2022. And so prices are going down in reaction to this problem. And to get us back to a market where prices are starting to rise like we're used to, we're going to need much lower interest rates. And as I said, those are still a ways off. We may actually have seen the peak for fixed rate mortgages. Variable rate mortgages are probably going to go up a little bit more because they are tied to what the Bank of Canada is doing. I'm not bearish on housing long term. I draw your attention to the announcement that the federal government is going to be bringing in 500,000 immigrants in the next year or so. And that is a tremendous support for housing prices. Immigration has always been that. It slowed down a bit in the pandemic, but now it is going to come on strong. Canadians, a core facet of the Canadian identity is you own a home. And I think there are young adults out there who are going to have to reconcile themselves to maybe not owning a home or not owning it in the city where they want to live. They may have to move to a less expensive locale. But I think Canadians want to buy houses, and insofar as they're not doing it right now, it is an affordability problem that can be cured by higher mortgage rates, driving housing prices down further. I don't feel comfortable talking much about a housing crash, and that's not a call that we're not going to have one. My wife and I bought our first house in Toronto in the early 90s. And back then I wasn't as savvy about personal finance as I was now. And we were wandering around looking at all these houses and thinking, why is this house on sale for $50,000 less than it sold for 18 months ago? That was because Toronto housing prices literally crashed. It took about 11 years for them to get back to where they were. I don't see that happening now unless there's some sort of an extra surprise in there that causes inflation to surge again, cause interest rates to rise, or that we get a extreme recession where there is a huge increase in unemployment. If you want to know what's happening in housing and what's going to happen, watch mortgage rates, but also watch the unemployment rate. People in housing say that the number they watch is the unemployment rate. It's when people lose their jobs and they're unable to pay their mortgages and we start getting defaults, that is when the housing market is on very tenuous ground. For now, we're getting a natural reaction to what we have to concede, it was an absurd increase in prices. It's an orderly decline so far. There's a lot of sort of I would say overly dramatic media coverage about this. Canadians have lost millions in home equity. Well, you didn't lose it because it was only just a notional number anyway. If you've owned your house for a long time, and you can see by this chart, you are still well ahead of the game. Now, a lot of boomers have worked home equity into their retirement plans. And if your plan requires you to sell your house at a certain price, I would consider looking at where we are now. It's not a great time to put your house on the market, though. I think in certain pockets, houses are selling in an orderly way. There are no more bidding wars, but well-priced houses are still selling. But this is only select properties that happen to be in the best neighborhoods or the best-looking properties. It's not a great time to put your house on the market. And I don't think there's any need to panic that all the equity is going to drain out of your house. This is a time to be patient and to see what happens. There's no need to be panicky that the housing pillar of your retirement plan is crumbling on you. This is what to expect from your investments for the long term. And I provide this to you because it helps anchor your thinking in good years and bad years. Last year was an exceptionally good year, totally out of bounds. It was a silly year. Everything was going up in price. You probably heard about the coverage of stocks like GameStop. GameStop is a video game retailer with locations in malls, and it was not a very dynamic business. And then all of a sudden it caught a wave of popularity with younger investors and produced meteoric gains in share price. It's actually still given back a lot of those, but it hasn't crashed. It was silly season last year. Good stuff went up, but so did low quality stuff. Now we've got a year of a pullback. So what is the reality of stock market investing? Is it the 20% gains of last year? Is it the 10% declines of this year? For an answer to that, I turn to guidelines that are produced for the financial planning business. And a team of people put this together. They're financial planners, they're actuaries, they're investment managers, serious people who want to produce guidelines for financial planners to use for projections of 10 years and longer. So this is what you should expect over a slice of 10 plus years. This isn't what's going to happen next month, next year, or even in the next 5 years. This is a 10-year slice. So look where inflation is, 2.1%. This isn't a prediction that inflation is going to fall quickly to 2.1. It's saying that on average, over the next 10 plus years, it will average 2%. That's basically where we were before the pandemic. So basically, it's a return to normal. You can see that the bond fixed income, that basically means bonds, a 2.8% increase. That's very much in keeping what we've seen. 6.3% for Canadian stocks, a tiny bit higher for foreign developed markets, basically the United States, and a little bit of a premium if you take on the extra risk of emerging markets. I actually think that's optimistic. I think emerging markets have been continually disappointing over the years, and I'm not quite sure, especially for retirees, whether the added risk of investing in emerging markets is worth the supposed extra returns. But if you work all these out, 2.8 for bonds, 6.6 for stocks, you're going to get balanced portfolios producing 3, 4, 5%, depending on how much you have in bonds and what stock markets you use and how much you pay in fees. We've all sort of had our nerves stretched a little bit in the last little while. We've had dramatically good things happen last year, dramatically bad things happen this year. I show you this chart here to give you some comfort. We are going back to a normal that will seem familiar to us, and we just have to get through these abnormal times that we're seeing now. A new settled, less volatile market is coming. And I think that you will see this in a 10-year slice. 2023 is probably going to be quite eventful because we have to still settle through the high rate story and the inflation story. But if you start to see inflation coming down in the first half of next year, that's a sign that the numbers in this chart are going to start to come into play. What to expect in the near term for your investments and your overall finances. Recession seems inevitable. The commentators who have talked about the recession to come have said it shouldn't be too violent. I would say that unemployment is going to rise. We've got a fabulous job market now. If anybody is toying with the idea of consulting, now is a phenomenally good time to go in. A lot of businesses are short of people. They're offering raises that the likes of which we haven't seen in ages. They're offering better benefits. They're offering the flexibility to work at home if you prefer to do that. You could, or to work from other countries. If you're wintering in Portugal, you could arrange with an employer to do that. So that tight job market, I think it's going to loosen a little bit, but everything I hear, there's so many retiring baby boomers that there is going to be a shortage of workers, and that is going to stop companies maybe from laying off quite as many people as they might have otherwise. But generally, a recession is going to put a strain on government revenues. We could see tough-minded budgets from governments in the next year or two. Come what may in a recession, we are not going to see more CERB, more Canada Emergency Response Benefit. You know, the government set this expectation during the pandemic that when catastrophic things happen, we'll be there and we will pump money into bank accounts for people and bank accounts for business. We did that. You can argue the merits of CERB one way or another. My personal view is that they were crucial in supporting the economy and confidence in that if you liked the house price gains and the stock market gains of 2021, you should thank CERB because they held the system together. It was a clumsy, but excusably clumsy effort because of the timeline they operated under. But government finances will not permit this sort of thing to happen again. The government understands that it owes a lot of money and interest rates are rising, and that sort of thing is brought widespread support for the economy is just not possible. Financial challenges for young adults. I raise this to you because I think that a lot of people in their 20s and 30s have been getting help from their parents and will continue to need it, perhaps with even more urgency. I just did some surveying of readers of my newsletter asking recent home buyers questions about how they're doing in the housing market. How's your mortgage? Are the payments going up? How much stress is that putting on you? And I'll give you a little tidbit of information that's relevant to you. 1 in 4 are getting help from their parents, usually in the form of cash. I think people who bought houses and had their mortgage rates and their mortgage costs go up substantially are hurting. And I think parents are stepping in, and I think a lot of parents are looking, taking an analytical view of what's happening with their kids and seeing if they could be of some assistance if they have the financial wherewithal. And I think you're going to find that the need for this is substantial, and we're We're talking about just living costs, daycare costs, mortgage costs. There's also, of course, on top of this, the issue of helping your kids get into the housing market. It's been a huge thing in Canada, and I don't see any reason why that will stop. Boomers have the wherewithal. Their kids are having trouble getting into the market. Sounds like arrangements can be made, and I don't see anything wrong with doing it as long as retirees are not taking a hit that will affect their ability to afford a comfortable retirement for a reasonable lifespan. And that has to be 90 to 100 years as a default. Your own health issues may dictate otherwise, but that's the number that actuaries want us to use. And finally, I want to leave some time for questions, but I want to I want to put some tools into your mind. Okay, so there are some new retirement products, new investment products that have been issued in the past couple of years. VRIF is the Vanguard Retirement Income Fund. It's an exchange-traded fund that holds stocks and bonds and is designed to pay distributions that produce a yield of about 4% on an annual basis. So on a monthly basis, you would get cash paid into your account from this ETF, and it's supposed to give you roughly a 4% yield. The share price of this fund will go up, it will go down, but the reason you would own it is to get that 4% income flow. There's also the Purpose Longevity Pension Fund. That is for people who don't have a defined benefit pension plan like you, but if you have family members or you know other people who are thinking, I need stable income, that is a new retirement product that I think is worthy of notice. I talked earlier about asset allocation ETFs, a diversified portfolio in a single package, and there's about 3, 4, 5 different versions, and they're for investors of all different risk levels. And if you want a simple solution to your investing on your own in your TFSA or your RIF, that is worth considering. Traditional advice continues to have a role. I think the profession of providing financial advice is migrating away from just managing your investments to also doing financial planning. How much longer will my money last? Can I afford to give my kids a house down payment? These are the kinds of questions that traditional financial advice providers should be focusing on. If you're working with someone and it's all about the investments, you should be getting more from them. Estate planning, tax planning, debt counseling, if that's needed. There's much more to this than investments, and I encourage you to draw down on that. And finally, there is such a thing as the fee-for-service financial planner. That's for the person who thinks, I have my investments covered off. Either I'm doing them myself or I've got a person who I trust, an advisor, but I need questions answered about my financial situation, about my retirement, about my estate, about taxes. And I would like to have a personalized plan or a personalized consultation done. I do not want to have investments made part of this, and fee-for-service planners do not do that. They charge an hourly or a flat fee, and they will discuss what you want to discuss. And if you would like a directory of fee-for-service planners across Canada, I invite you to email me, rcarrick@globeandmail.com, and I'd be happy to send you a link to this directory. It was produced by a financial blogger, and it is comprehensive coast to coast. I've done many talks like this, and I have never failed to get at least 1 or 2 dozen people emailing me for this list. This is where you go, these kind of planners, to get questions answered and uncertainty solved. That is the end of my slideshow, and I would invite you to ask questions now. Lay them on me.
Alors, rebonjour. Thank you very much. You did cover a lot of information, and we have a lot of questions. So I'm going to try to get a good sample of more micro and micro type of question. So, what is a good source for understanding ETF investing?
If you'd asked me that question 20 years ago, I would say, oh, there's a number of books on the topic, but nobody's really written a book recently. So I think what you're going to need to do is just do some Google researching, find some good some good sources. I would suggest you start with the big ETF companies, iShares, BMO, Bank of Montreal, and Vanguard. They have the bulk of the ETF business in this country. They've got lots of educational material on your website. I do an annual ETF buyer's guide. I cover 6 different categories of ETF, and I pick the ones that I think are good candidates for long-term investors like you. And so if you Google Rob Carrick ETF buyer's guide, that would be a good starting point. That could sort of produce a long list of ETFs for you to research in a bunch of different categories.
Okay. Is it still possible to transfer cash and or stocks to children or other people without paying any tax?
Well, you can gift. The ideal thing is to gift your kids money for their TFSA, and let them buy the stocks that way. That way, there's no tax for when you gift money to put into a TFSA, and once the money goes into the TFSA, it's perfectly tax-free. So that would be, if you want to avoid tax complications and you're gifting your kids money, or you want to encourage them to buy securities, stocks, ETFs, mutual funds, whatever, that would be my suggested tactic.
Okay. Well, I lost my screen. With GIC ladder effect, what are the best time frame to go with GIC? More in a 1 year or 2 years, 3
really,
5 years?
I'm glad that this person asked this question, because what's complicating that is that the returns are almost the same for 1 through 5 years. So I would say go for 1 year or 2 years if you think you might need your money in the near term. Once you put your money in a GIC, it's locked in. You can't really get it out. So you've got to be thinking, if I put it in for 1 year, I have to wait 365 days to get the money, or twice that for a 2-year GIC. What I like about 5-year GICs is that it's a very good return, historically speaking, and it's guaranteed for 5 years. And I'm pretty sure when your 5-year GIC matures, you're going to think, if only I could get that again, but I can't. So I would say if you have money that you are totally comfortable locking down, I would go with the 5-year term. I think 5% for 5 years is very good. But if you can't lock in for money that long, you're still going to get a very good return from a 1-year GIC. So I say pick the term that suits your financial planning needs. Don't try to make a super smart, savvy call or a bet on interest rates. Lock the money in for just the term you think suits your needs.
Okay, thank you. If I retire at 60, but don't take CPP until 65, should I continue paying into it until I reach 65?
It's a hard question for me to answer because I don't know about the particulars. There may not be any reward for doing that if you are already maxed out. If you've already had the requisite number of years paying into CPP at the maximum rate, I suspect there may still be some benefit to it, but it would depend on, like I say, your career trajectory. Were you making great money all the way along, or did you work your way up? That sort of thing. If it's somebody who took years out to raise kids, that could I think the extra 5 years would be quite helpful.
Thank you. What are your thoughts on buying gold to try and add to my portfolio?
I'm not a big gold fan. I don't get gold. People say, oh, it's a hedge against uncertainty, but gold just goes does big zigzags all the time, and I never understand why it's doing them. And I look, there's a lot of uncertainty in the world today. Gold must be doing great. Nope, actually, gold's going down. It's very unpredictable, and I think we love the idea that if we buy gold, we have something that has a value, and that, if the world falls off its axis, we have gold, and that's a great thing. But gold is a very tough, volatile commodity, and it doesn't perform like we think it should. And because of that, I'm a bit leery of holding it. It doesn't pay dividends. It doesn't generate profits so that you can sort of judge, is this good to continue to hold? it does, there are times when it does well. And if it gives you confidence and comfort to hold it in your portfolio, I say, sure, go ahead. I don't think it's a big mistake, but I don't think it's the big portfolio saver that some people think it might be.
Okay, thank you. Mutual funds and ETF have both decreased by about 15% this year. Apart from the fee issue, which do you think will see a quicker, bigger recovery, and hence where should we continue to invest during this?
That's an interesting question because of the background here. Mutual funds are managed by managers who pick the stocks for the most part and the bonds, and ETFs for the most part, but not exclusively, track indexes. So if we sort of pick the bottom point for the market and we say who's going to do better bouncing off this bottom, the managers who pick their own stocks or the indexes themselves, I have a high level of confidence it'll be the indexes. I'm not sure about it, and there will be some individual managers managing mutual funds who will do better, but history tells us that over all kinds of different time frames, the indexes tend to do better than the mutual funds where people are picking stocks. Part of that is because it's very hard to pick stocks in a way that matches the index, and also mutual funds have higher fees, so that's a bit of drag on returns, whereas index tracking ETFs have very low fees. So if I were to pick one that I had the higher level of confidence of doing better, I would pick ETFs.
Okay, thank you. How would you rate the Bank of Canada vis-a-vis the US Federal Reserve in terms of addressing inflation?
I would address it exactly the same, and my mark would be a C, maybe a C minus. There's a lot of people who are like angry and bitingly critical of the Bank of Canada. I'm not. You know what? We were dealing with a very, very volatile, unprecedented situation with the economy during the pandemic, and we had lockdowns, and then it opened up, and the economy locked down again. The Bank of Canada wanted to avoid a recession/depression, and they overdid it on the stimulus. But who knew? Who knew how bad things were going to go? Who knew that the vaccines would come in as quickly as they did? Yes, they should have raised interest rates sooner, but it's a very, very tough situation they were handling. I wish they'd raised rates sooner. I don't really hold it against them, but I think that there were enough warnings out there that inflation was going to rise. That's why I give them a mark in the C range. And the U.S. Federal Reserve is in pretty much the same boat.
Okay, so two more questions. For GICs, how do you suggest we handle the investment interest once the term is reached to minimize impact on taxes?
Well, you know what, your TFSA is a very, very good place for GIC investing because it's tax-free. You know, at a high marginal tax rate, you could lose, I mean, we're talking about how great interest rates are, but at a high marginal tax rate in a taxable account, you could lose like close to half this great interest you're being paid because interest is taxed like regular income. That's why I suggest you put them in TFSAs where possible. If you have GICs in your RIF, it's the same as, RIF withdrawals are taxed like regular income. GICs in non-taxable accounts, or in taxable accounts, I should say, are taxed like regular income. All arrows point to the TFSA as the place for that. Otherwise, in a taxable account, you're just going to have to live with the fact that your GIC interest is taxed like your other income.
Okay. So I should have said three more questions. So now I have two more questions, and we'll finish after that. Could you comment on the government-backed Ukraine bonds?
I cannot. I have not taken a close look at those. I assume it's the government of Ukraine that's backing them. And if so, I would say that that's going to be a risky bet, and you would want to be compensated for it via the interest rate. So I showed you a chart earlier, Government of Canada, 5-year bond, the yield on that, or the interest rate, is about 3.5%. You would want to see something substantially higher than that for investing in a country that's in a volatile situation.
Okay. And finally, you recommend, whoops, I just have to move something here. Recommend continued use of the 60/40 portfolio. What are your thoughts on shifting the bond component to a mix of GIC ladder, heavy on GIC, and some bonds?
Thumbs up. Thumbs up on that. I think it's a really good idea. I think, when interest rates start to fall, bond funds are going to do really well. And there's going to maybe be a year where bond funds are up, let's say 5 to 10%. And you're going to be thinking, wow, I'm so glad I did that. And if you have bond funds or bond ETFs or actual bonds in your portfolio, you're going to capture that rise. And GICs won't do that. But if we get more damage for bonds, your GICs are going to hang in there and hold steady, and they're very predictable. Like the 5-year 5% return, very predictable. Do I think bond funds are going to give 5% returns annually over the next 5 years? I don't think so. You might get a great year when we get interest rates lowering, and then maybe some calm, quiet years of 2 to 3%. So I think the mix of bonds and GICs is a very smart way to go. It's well diversified, and you're covering all bases. You've got the safety of the GICs and the predictability, and with the bond exposure or bond funds, you've got the ability to capture a big rebound in the bond market that very likely will take place in the next 12 to 18 months.
Okay, thank you very much. That's the end of the question, but we've been asked if you could repeat your email address, please.
No problem. It's rcarrick@globeandmail.com. It's all spelled out, globeandmail.com. And if you forget it or you copy it down wrong, just Google my name and my email address. I'm well represented on the internet along with my email address.
Okay. Well, thank you very much. I will now turn it over to our president, Roy.
Thank you, Helene. Fellow members, thank you for your participation in today's webinar. On behalf of the National Association of Federal Retirees and the Ottawa branch, we thank our speaker, Rob Carrick, sincerely. Rob, we very much appreciate your direct, straightforward approach to help us all increase our financial literacy. We also thank the staff at the Ottawa branch and the national office for making this truly collaborative event happen within a very short time frame. I want to remind everyone to watch for our follow-up email, which will include the link you can use to access the recording of today's webinar and slides. We hope you will decide to participate in our mega recruitment drive and refer new members. We need your help to grow so that we can continue to offer great experiences to our members. Rob, again, thank you. Thank you all. We will see you at our next event. Merci beaucoup et au revoir.